For ASM member, please be reminded to check in the attendance using the QR code or log on to the Google website. The link can be found at the chat box on your right. This is for CPD recording purpose. Number 2, if you have any question, please post your question using Slido. Please join the Slido. You can type into your browser, slido.com, with the access code 98931. Again, you can find the number at the chat box on the right. We'll try to address your question during the Q&A session at the end of the presentation. Today, Aiza will speak on how the regulation in Malaysia has helped Takaful prosper relative to many other countries. Aiza is a partner actuary at Actuarial Partners Consulting in Malaysia. She qualified as fellow of the UK Institute of Actuaries in 2002. In the following 18 years post-qualification, she heads a team of actuarial associates within the PR office and is involved in consulting projects to life insurer and Takaful operators, including traditional roles such as in valuation, pricing, M&A due diligence, capital adequacy assessment, ICAP, model review to market feasibility studies. Other roles include consulting work on ALM and operational risk audits for wealth fund. This is complemented by work in projects on social security and microinsurance. She looks forward to embracing the challenges and opportunities that IFRS 17 is set to bring to the industry. Okay, now over to you, Aiza.
Thank you for that. Sorry, it's 18 years of experience having to be summarized into two sentences. Assalamualaikum, good morning, everyone. Thank you for joining me in this webinar. I'm speaking about regulations behind the success of Takaful. I hope you can see my screen. Is that good? Joanne? Okay.
Yes.
Assuming that's up? Okay,
yes.
Great. Okay, so I'm speaking today about regulations behind the success of Takaful in Malaysia. This is the second webinar of a series of 5 webinars that Actuarial Partners Consulting is conducting in collaboration with the ASM. We're speaking about Takaful here. The next 3 sessions addresses the issue of the day, how to apply IFRS 17 to Takaful. But my session and the previous session by Shu and Emma, we're talking about laying the foundation for Takaful so that we can understand this better and then move on to IFRS 17. Okay. So today is on regulations, but before we get into the thick of things, I wanted to highlight what I thought was 3 success factors for Takaful in Malaysia. I'd summarize it as 3 factors. So the first one, of course, is the regulations, the regulatory environment. We have a very supportive government here in Malaysia, and that's evident in the development of Takaful-specific regulations. And why regulation is important, of course, is because it promotes financial stability as well as giving some consumer protection. But for Takaful, there is also a conflict of interest between the operator and the participants in the risk fund. So the conflict is not the typical insurance sort conflict where they want to not pay as much as possible the claims that comes if they don't pay, then that translates to profit. But it's more between the role of the operator, who is remunerated based on fees, and the tabarut that's dripped into the risk fund. And the more they can earn as fees, the more profitable the entity becomes. So we'll see how. I'll speak about that in a little while. But that's one of the conflict that the regulations tries to address. The other key factor why I would say it's been successful in Malaysia, and when I say success, it's also because Malaysia is a large Takaful market globally, and for family Takaful, it is the largest market globally. So what drives that is also a very strong Islamic capital market environment. What this means is our Takaful operator have the ease of investing in Sharia compliant assets. So if you think about an insurance company, typical investments are fixed income, equities, cash, So if you don't have a strong environment, you'll have difficulty placing your cash in a Sharia compliant fixed deposit in a bank. So we see that happening in countries outside of Malaysia. Fixed income as well. In Malaysia, we have a very steady market. I mean, this is where we are now. In the beginning, it wasn't very strong, but we have corporates issuing sukuks, fixed income Sharia compliant bonds. We have our government issuing GIIs, which is the Sharia compliant version of government securities. So with the availability of those kind of investments, it's easier for Takaful operators who have longer duration of liabilities to find matching assets. And if we go into equities as well, our Securities Commission every half year, it issues a whitelist of what stocks are considered Sharia compliant. So it's a strong capital market environment, an easier way to invest in Malaysia, and that has propelled the success of Takaful. We see operators in other countries where it's not so fully developed struggling a little bit in terms of trying to find those yields to match their liabilities. Third is, of course, this ready market of Muslim consumers here in Malaysia. So 65% of our population is Muslim. So that creates a natural demand for Sharia compliant insurance. Do Muslims buy insurance rather than Takaful? We still do. They still do here. And you can see Takaful is actually a very small proportion of the insurance market. Our insurance penetration rate here for Takaful is still a very small number compared to the conventional sector. But in terms of growth year on year, we are growing faster than conventional. Do non-Muslims buy Takaful? So the value proposition for Takaful, I would say, is twofold. One is because of the risk-sharing nature, which means that if you contribute to the risk fund and there's a good claim experience, there will be some surplus back to participants. So the surplus sharing nature is one value proposition. And the other value proposition was this ethical nature of investments. Because investments are Sharia compliant, so stocks like are involved in, for example, for gambling, liquor, pornography, highly geared equities, those are avoided. So these ethical investments actually appeal to non-Muslims. So we do see non-Muslim as well taking up Takaful here in Malaysia. So it's not just for Muslims. Okay, so those are, I would say, the three success factors for Takaful here in Malaysia. Going into the thick of things in terms of regulations, these are the regulations, and this is by no means comprehensive or exhaustive, but these are the key regulations that came out in Malaysia to govern Takaful operator and in the wider set of Islamic financial institutions, right? Some of these regulations, they kind of mirror what's happening on the conventional side. So the IFSA, the Islamic Financial Services Act 2013, came on board along with the Financial Services Act governing the financial institutions here in Malaysia. RBCT, that RBC framework here at the bottom, that came out a bit later compared to the RBC framework that is issued for conventional insurers. There are also specific Takaful related regulations, which are the TOF. I'll speak about a bit more about that later. So as you can see, our central bank, which is our governing body for Takaful operator, it has been very busy. So for today, I wanted to focus on three key pieces of legislations, the IFSA, TOF, and the RBCT. So what I'm doing here really is not to explain what these acts are, but more in terms of highlighting what are the Takaful specific bits that are different that was applied to Takaful. So IFSA, first of all, is a Malaysian law that's enacted in 2013 to govern Islamic financial institutions. So they also govern the banking sector. And the the main aim is to promote financial stability and compliance with Sharia. Okay. This came about to replace the Insurance Act 96. And when this was issued, the two bits that affected the conventional sector as well was the need to have a holding company at the top, and the need they banned composite license under the IFSA 2013. So composite license had to be split between the life sector and the general sector. So for Takaful, that's the family sector, and the general Takaful. So if you see, if you're following Shuhada's presentation on Monday, you would see that we have very few general Takaful operators, and that has come down recent years because when they split the license, they found that for general Takaful operators that are very small, it didn't make sense to hold that paid up capital to support the business. So slowly people were withdrawing or consolidating. So that explains why we have very few general Takaful operators in Malaysia. On the next one was on TOF. TOF, the first one was issued in 2010, and it's later superseded last year in 2019. It's actually effective, I checked just now, it's effective 1st July 2020. And this TOF, it provides additional guidance dealing with the specificities of Takaful business. So I'll give you a flavor of what it covers in my next few slides. Right? RBC framework for Takaful operator was issued in 2012, applicable in 2014. And this came a bit later than RBC framework for conventional. And possibly it's because in 2014, Takaful the industry was still very small. And the paid up capital then, I suppose, was more than enough for the small size of the business that was written then. So in 2014, RBCT came into effect here in Malaysia. Okay. Let's go into the IFSA. So as I said, I'm not covering everything that's within the legislations, but highlighting pieces that's applicable to Takaful. So in the IFSA, what is Takaful is actually defined. So what is Takaful? Takaful is defined as an arrangement based on mutual assistance between Takaful participants, right? But that's Takaful. What is a Takaful operator? Hold on. A Takaful operator, let me just hide this a little bit. Can't see it, okay. It's a person licensed to conduct Takaful business. So another step, what is Takaful business? So Takaful business is defined in the IFSA as business relating to administration, management, and operation of a Takaful fund for its Takaful participants. So if you see here, it's very careful to avoid any implication of risk transfer. So it's an operator that manages, right? A licensed Takaful operator is an operator that manages the Takaful fund for participants, right? So Takaful is a mutual assistance between participants. Operator here does not assume any underwriting risk. And if you look at the winding up requirement within the IFSA as well, so of course on the wind up, you need to pay for any liabilities to participants and to other debtors. But in a case, just to highlight this bit, where in a case where there is a surplus of assets of the Takaful fund, the last 2 points I have at the bottom there, the first is to meet liabilities of other Takaful funds managed by the licensed Takaful operator, which are deficient. So if you have a surplus in one fund and you see a deficit in another fund, on wind up, you can use that surplus within that profitable Takaful fund to plug the deficit to meet those liabilities in the other funds on wind up. Second, any other purposes prescribed by the bank. So what's missing here, you can see, is that it doesn't mention that the surplus of the Takaful fund will go to the operator. That's a key distinction between Takaful operations and insurance companies. If you think about general insurance or non-participating business or family Takaful, you'll find that on wind up, any surplus actually is owned by the company, owned by the insurer, And even if you go deep into participating business where there is an estate, right? That estate, the orphaned estate that's not allocated to current the current policyholders, those are actually by law defined as owned by companies, by the insurer, not like Takaful, where it's owned by the other participants. Okay, so that's a key distinction. What is this responsibility of the operator? First is to establish and maintain Takaful funds. So what that means is you can have one or more Takaful funds. For family Takaful in Malaysia, you're bound by the regulations to have the annuity fund separate from other funds. Investment linked operator fund as well is separate. The risk fund is separate for investment linked. For general, you would assume that motor would be separate from fire, from other classes of business. But for general Takaful in Malaysia, I think they're still within one fund, right? So that you decide as a company, and you get approval from Bank Negara. But key point here is this requirement for Takaful funds to be kept separate from shareholders' fund, right? So if you look at the financial statements of Takaful operator in Malaysia, and this relates to a question from previous presentation, whether you can see whether the risk fund has a card, is in deficit. If you look at the financial statements of Takaful operators in Malaysia, it's very clear that the accounting is distinct between what is shareholders and what is the risk fund. So you can actually check on the health of the risk fund, and you can check how the shareholders, the operating fund is doing. So it's kind of like dual reporting, right? And the other obligation that is placed on the operator is that if there is any deficit within the Takaful fund, so let me read that. FSA imposes an obligation on a licensed Takaful operator to, I have to move the screen a little bit away. To provide a form of financial support to the Takaful fund. So if there's a deficit in the risk fund, there's an obligation by the operator. So if you're licensed, you're obligated to meet the deficits within the risk fund. Okay, so that's the key responsibilities of the operator. The other new bit, if you compare this IFSA with the previous Insurance Act, is this introduction of a Sharia governance framework. So there's a whole section within the FSA that talks about Sharia governance. How is this achieved? This is achieved by having an additional layer of governance in the form of a Sharia advisory council, right? But there are differences in opinions in terms of Sharia opinions on certain matters. So what Bank Negara has done is to have the RSAC to be the sole authoritative body on Sharia matters. So I'll give you an example of what could be a difference in opinion in terms of Sharia. A long time ago, for family Takaful operators, they were grappling with the idea of whether claims should be paid on suicides. Obviously, it's suicide is not Sharia compliant. But so one view was that shouldn't be covered. Benefits shouldn't be covered on death due to suicide. But another view was that the people who you're helping would be the next of kin, so they will still be in need. So there was discussions on whether that should be covered. So I saw, I checked in Syarikat Takaful Malaysia's policy contract, and that says there's a 1 year waiting period, but after that, death due to suicide is covered. So if there are issues, similar issues, you could actually go to the SAC of Bank Negara, and they would be the sole authoritative body to decide on those kind of issues. If you visit the Bank Negara website, there are 9 council members on the SAC, and they are either Islamic jurists or Sharia scholars, but they all have market experience, market practitioners. They have experience there. Okay. So let's talk about examples of Sharia committees' responsibilities. So again, the Sharia governance framework governs the company practice, covers stakeholders' scope of duties and responsibilities, and provide details on processes and procedures in operations of IFI with the aim of observing Sharia compliance. So that's a whole mouthful, right? So what are the examples of this, of what they do, or what Sharia committee does? So I've put down a list here. So they provide Sharia advisory and consultancy service in all matters relating to products, transactions, and they advise the board and management on Sharia related matters. So it's more an advisory service to the board, advisory service to the management. But they also endorse Sharia policies and procedures. And one way that we've seen that happen is they endorse and validate relevant documentation. So from brochures that are used for the selling process to the legal documentations in terms of the policy contract, the Sharia committee would actually endorse and validate those legal documentations that they are Sharia compliant. One of the requirements of the IFSA is also a Sharia audit. So the SC's responsibility is to assess the comprehensiveness of that Sharia audit, make sure that's being done, and review the findings as well. The more visible role of a Sharia committee to an Islamic financial institution, this applies to banking, not just to Takaful, is to report to shareholders that TO's activities are in accordance with Sharia. So you will see within the financial reporting that there will be a report by the Sharia committee that talks about the Sharia compliance. And some of the issues that they cover would be, example, the allocation of profits, right, between to the operator. Zakat. Zakat is tax calculated using Sharia principles. It's roughly 2.5% of income and needs to be paid to approved bodies. The SC's report as well would talk about how earnings that are non-Sharia compliant have been disposed. So this is like, they call it cleansing. So if you have earnings that are not considered Sharia compliant, for example, interest on deposits, or if you bought into an equity that subsequently drop off the Sharia approved list, and you've made a big gain on it above a tolerance limit, what do you do with it? So the Sharia committee actually reports in terms of how that has been disposed. And overall, it will give a statement in terms of whether those activities have been done in accordance with Sharia. So that's what they sign off on in the financial statement. So that's one of the more visible responsibility of the Sharia committee. Okay. So that's IFSA. So it defines what Takaful is, what Takaful business is, what the operator is, this big thing about this Sharia governance framework that's governed within the IFSA. So that's a whole new section that applies to both banking and Takaful. So I want to talk a little bit more about RBC for Takaful. The RBC capital framework, the risk-based capital framework, fondly known as RBCT for Takaful, is very similar to the conventional framework. What I'm going to highlight here are where it's different, right? So first, why it's similar, the supervisory level is set at 130%. So that's similar to conventional. But where it's different is, remember that they have the distinction between the risk fund and the operator fund. So the expense risk charge and the operating risk charge needs to be met by the shareholders fund to reflect where these risks reside. So next slide, I'll be speaking about that. The other distinction is the capital resource from the shareholders' funds are all fully available to meet capital requirements. So there are available capital, but within the Takaful fund, the capital resource is only recognized up to the amount of supervisory capital. So I'll give you an illustrative example later. How about card? So card, the loan that is given from the operator to the risk fund to cover any deficit, that's treated in the RBCT the same as subordinated debt. But when you calculate CAR, you need to deduct the amount of CAR from your total capital available. So that's how CAR is treated in the RBCT. Okay. So I'm going here into a very big overall view of how the RBC risk charges are calculated. So if you look on the left-hand side, the first column, those are the risks under the general risk under an RBC framework. And this applies again to conventional as well. So you have capital risk charges applied on assets that you hold. So if you hold fixed income, there's credit risk charge. If you hold equities, there's a market risk charge. On liabilities, it's been split between the Takaful fund that is in charge of meeting the Takaful related liabilities, and for the shareholders for the expense liability. And then as well, that's the operational risk charge, which in Malaysia, that's calculated as 1% of asset, and that applies across all the funds. So if you look at the asset risk charge, so assets within the risk fund and the shareholders funds would attract some charges, some credit and market risk charges. And further within the Takaful risk fund, there's also a charge for any mismatch of assets and liabilities. So that needs to be parked under the risk fund, calculated under the risk fund. Liabilities as well, risk fund is in charge of Takaful liabilities, so those charges within the risk fund, expense liability within the shareholders fund. Operational, in Malaysia, that's calculated as 1% of asset, that applies across all. So what I've highlighted here in dark gray, the darker shades, is that some of these assets within the RBC framework, it needs to be met by shareholders funds. So you can't use surplus from the risk fund to meet this charges. So it means that you need to have capital to meet those charges. Okay. So I hope that's clear. So risk fund, in terms of risk charges, it's similar to conventional. There is a segregation between risk and shareholders fund on how those charges are calculated. And for expense and for operational risk charge, these capital charges need to be met by shareholders. So I hope that's clear. So that's one distinction with RBCT. So let me talk a little bit, this funny column that I have in the middle that has two colors on it in terms of the Takaful liability. What do I mean by that? Okay, so if you think about a risk fund, this is a very simplified version. So you think about a risk fund, the darker green at the bottom represents my the statutory reserves, the best estimate plus the PREP to meet that typically 75th percentile statutory reserves. So anything above that is a surplus. The fact that this is very big here, that's not representative, it's just for illustration purposes. So you have a big risk fund surplus. On top of the reserves, you need to hold capital, right? So there's a total capital requirement, TCR, to ITCL. ITCL here represents internal target capital level. So your supervisory level might be 130, which is what it is in Malaysia. But the ITCL could be higher. Typically in Malaysia, that's around 180, I would say. So if you have a capital risk charge of 100 in total, you need to hold more than that. You need to hold 130 for supervisory level. And if as a company you decide internally you want to hold a higher capital level, which is expected, say 180%. So you would need to hold 180, even though what's calculated is just 100, right? And what is in our RBCT, what surplus that can be recognized as TCA is kind of cut off here. So you can only recognize surplus up to 1/30 of the TCR. So only a portion of that surplus can be counted towards capital available. So but then you need to hold ITCL, right? So who holds that capital up to ITCL? The operator. The operator has to meet that balance. So I'm not sure why, not certain, certainly, why this is within our RBC framework, but I think it's because they didn't want to encourage an accumulation of too much surplus within the risk fund. I think the regulators were kind of encouraging that surplus to be distributed back to participants, to be shared back by participants, rather than held back within the risk fund. So, I mean, that's my hypothesis on why this has come about, this cap here. So for each Takaful fund, capital resource are only recognized up to the amount of the supervisory capital, right? So the rest has to be met by the operating fund. So this actually poses a challenge, right? Because even though you have a surplus, you might have a surplus within the risk fund, it's not self-sustaining. You have an immediate formula-driven capital deficit. So the shareholders would need to fund for that extra capital, even though the risk fund is healthy, right? So there is a cost of capital to shareholder of writing Takaful liabilities. It's not such a big issue in Malaysia. Well, two things. One is because by nature, Takaful doesn't have that much guarantees. So for those kind of short-term Takaful products, the Takaful liabilities are not very big, the charges are not very big. But then having said that, a significant portion of our business here in Malaysia is actually mortgage credit protection, so MRTT. So here in Malaysia, you'll have Takaful to cover housing loans, and that's usually calculated as a single contribution for a very long term. So the housing loan can go up to age 70. So you imagine the duration of the assets. So that is more of a risk charge on that. So for those risk charges, even though there's a healthy surplus, you have this immediate formula-driven capital deficit. So implication is the operator has to bear the cost of capital beyond that supervisory level. So you need to have capital to meet those charges. The other hidden implication as well is that because you can only limit up to 1/30 FTCA, so if you have funds that are healthier than other funds, you cannot cross-subsidize the risk funds, right? So if you have one fund, for example, if you think about general Takaful, you have the fire risk funds, if you actually split it. If you have a fire insurance, fire Takaful, that is a very healthy profit, and you have bodily injury motor in a separate risk fund, which has a deficit, you cannot cross-subsidize. And very different than how a conventional operation would work, because that's free for all. So that proves a challenge for Takaful. Okay. The other thing I wanted to bring up in RBC as well, in the RBC framework as well, is this expense liability. This actually is applicable for both conventional and Takaful operator. There's regulators expect within the valuation of liabilities that if you have an expense overrun, you need to capitalize those future expense overrun. So you need to hold that future expense overrun as a reserve, right? For most conventional players, that's fine because they're large enough. But for Takaful operators, quite a few of them have not yet reached critical size, so that's quite painful to meet, right? That you have to capitalize your future expense overruns. Okay. So we've talked about Takaful, about RBC. Let's just take a step back because that's quite a heavy topic. Okay. Let's talk about how a product is structured under Takaful. So I've drawn a cute pie chart here. If you can imagine this pie chart on the left, that is your total contribution that you would set the price, right? This is your pricing. So in your pricing, when you sell a Takaful product, you would have a portion for expected claims. You would also have a contingency margin on those expected claims. You would want a wakala fee, and that wakala fee, you want to ensure that it's enough to pay for your expenses, to pay for your commission, with a little bit of margin, and everything else is considered a profit loading, right? So a few points here. So, there's an incentive, of course, for the Takaful operator. Oh, sorry, first point. So for the Takaful operator, this is a wakala model that is typical in Malaysia. So you have a wakala fee, but here in Malaysia, the profit loading, the surplus within the risk fund, you can have a share of up to 50%. So for every RM1 that you distribute back to participants, the shareholder, the operator can receive the same RM1, right? So it's a 50-50 share. So that's typical of the product structure here in Malaysia. I'm aware that for example, in Brunei and Sri Lanka, there's no distribution to shareholders, okay? But for Malaysia, at least, there are two sources of income, from the wakala fee and from the surplus distribution, right? So there's an incentive, right? If you wanted more profits as a business entity, to have higher wakala fee, right? So you imagine, if you have a higher wakala fee, that would mean that your pie, the cost of your Takaful product should be larger, right? It would be a lot bigger. So it becomes more expensive. Your Takaful product is now more expensive because you want a higher wakala fee. And that's all very well if you can sell that product, but we live in an environment where it's very competitive. So typically the pricing, you need to be competitive, you need to be similar to competitors. So the pricing is kind of where it is. So how much wakala fee you can take is really a function of all those expected claims and everything. But there's an incentive for some players, sorry, if you're profit driven, if you're just profit driven, to have a larger wakala fee, and that means you could either forget about the profit loading and just whack the profit loading into the wakala fee so you can recognize that profit upfront. And if you are unethical, or if you are desperate, you could actually have a wakala fee that whacks the profit loading, the contingency margin, even the expected claims even, and to have as much wakala fee as you want as profits. Because what happens in the risk fund is you're not undertaking the risk. The risk is with the participant. So if you're unethical, you could just price it such that the tabarruk portion is very small, and perhaps unsustainable, but earn a high wakala fee. And I hope you're following this, right? So I welcome any questions. You can put it in Slido, and I'll try and explain this a bit better then. But that's what I'm saying is this function of this wakala fee. How much can you get, right? So we're fortunate in Malaysia because the TOF framework actually recognizes some of these issues and provides guidance. And these are marked as standards that Takaful operators have to adhere to. So I'll talk about surplus distribution a little bit later. But here, in terms of pricing, the focus is on policyholder protection. So within our TOF, within our Takaful operating framework, it talks about exercising prudence and due care to ensure that the price of the Takaful product is appropriate and reasonable. I leave it to your imagination what is reasonable, but I imagine that that when you consider the structure of the product, a lot is going towards meeting claims rather than meeting profits. So I would deem that reasonable. Okay. There's also guidance from TOF in terms of how much wakala fee you can take, right? So it doesn't give you a percentage, doesn't give you a fixed number, but the guidance is your wakala fee needs to reflect the services undertaken. Because remember, the wakala fee is to you as an operator to manage, right? So it needs to reflect the services that's undertaken, and you can only charge it once. So if you've put in a loading in your wakalah fee, for example, for investment activities, you can't have another investment related charge going forward. So you can only charge it once. So you have to decide where you want it. It's a bit silent in terms of the profit that you can build into your wakalah fee, right? TOF is silent on that. But this is, the other bit is interesting as well, because the wakalah fee that you can charge, remember that example I gave you where it's very competitive and this is the price that you take, and from a commercial standpoint, you want as much wakalah fee as you can, and you might want to take more than you should, and the tabarruk gets too small, right? So the TOF gives guidance that you need to preserve the interests of the takaful participant and ensure the long-term sustainability of the takaful fund. So the wakalah fee that you take needs to ensure still the long-term sustainability of the risk fund, yeah? So calls the question, what guidance is there in terms of tabarruk into the risk fund? So the TOF talks about adequate tabarruk charges into the risk fund. So it has to be adequate. You cannot deliberately underprice, right? Or deliberately charge a very small, inadequate tabarruk charge. So it needs to be adequate to cover risks and obligations. And this is other interesting bit, which is part B here, that talks about the takaful contribution being sufficient to cover tabarruk charges throughout the term of the takaful product. This is sustainability, right? So I'll give you an example. So if you were writing medical or even family term cover, the tabarruk, the risk charge actually is higher as you age, right? If you look at your attained age, as you age, those charges will become higher. Those tabarruk charges are higher. But the takaful contribution, the premium, would typically be calculated at a level premium. So here, what they're saying is that level contributions that you collected, you have to ensure that it's sufficient to cover even those tabarruk charges in those later years, so throughout the term of the product. So when you sell, you need to be careful in terms of how you communicated that term of that takaful product. So if you say whole life or up to age 100, your contribution needs to reflect that. So there's a lot of guidance here in terms of the operational bit of TOF. Okay. There's also, so now that you've priced correctly, you've done very well, and there's within the risk fund, there's sufficient margins to generate a surplus. What do you do with that surplus? So the TOF provides guidance here. It requires a surplus distribution policy, right? And this policy needs to, of course, define what the surplus is. If you look at the policy contract of Takaful in Malaysia, if you compare that in previous years to now, the surplus or the profit is actually very vague. It's not put in a very comprehensive manner. So it talks about profits, company profits, but it doesn't define what profits mean. Some of them that I've seen recently make reference to meeting first reserving and solvency requirement before any surplus is distributed. So what the TOF is saying is, you might not put it into your legal contract, but you need to have an internal surplus distribution policy. And this surplus distribution policy needs to be formalized, meaning it needs to be sent out to the board, and it's also sent to the regulators. So the regulators actually will have a view in terms of your surplus distribution policy. And this surplus distribution policy, if you go back to my chart earlier, it is actually important because how you define surplus, how you want to distribute, can either accelerate or it can defer the emergence of profit, of your own profit, right? So that's why it needs to be formalized. And every year, when you have a surplus distribution, that surplus that you can take out from the risk fund needs to be recommended by the appointed actuary, and it has to be endorsed by the board. And the appointed actuary actually has further guidance. If you look at the regulations, they need to make sure that the long-term viability of the risk fund is not impacted. So there are also guidance. It's not just the project actuary signing off, but they need to show that they've looked at the long-term viability, whether you can actually afford to pay that surplus. And for me, when I act as an AA to recommend that surplus distribution, I will actually go back to the surplus distribution policy and check that I've met all the criteria. And what I sometimes see is in the surplus distribution policy, it also talks about maintaining a certain buffer. It talks, for example, maintaining a car at a bit higher than the supervisory level. So I've not seen mentioned compared to the ITCL. ITCL is a lot higher, but because of that limit of recognizing capital, so it mentions at the supervisory level. So there is a buffer, and anything above that is up to the AA whether they want to recommend a surplus. And when you recommend a surplus, you look at the long-term viability of those funds. Right? So TOF governs pricing, governs surplus distribution. What happens if you have a deficit? Right? You can also, deficit in Takaful can arise from a few things. One is just fluctuation, claims fluctuation. It also can arise from solvency requirement. So if you remember, the IFSA says that you're obligated to provide financial support. And within TOF, it talks about either providing a loan, and that loan needs to be repaid from surplus arising in future years, or if you are kind enough, the operator can actually provide a hibah. A hibah, literal translation, is a gift, right? It's a gift. So there's no obligation of repayment to rectify the deficiency in the PRF. I've actually seen hibah happens in practice, not in Malaysia, but I've actually seen operators actually providing a hibah to rectify the deficiency within a risk fund. In Malaysia, typically the card approach is taken. Okay. How about if the deficit is due to mismanagement or negligence? That the TOF says outright transfer. You need to meet that deficit from an outright transfer from the shareholders fund. So it's mismanaged or negligence, no card, outright transfer. Okay. How about the TOF governing card? There's card repayment. So it talks about having a policy that covers the manner of repayment. So that we bump surplus arising in future years. What happens to the surplus distribution to other participants when you have a card outstanding? This is important, time period when card is repaid. So you need to have a projection on when the card will be repaid and address potential adverse impact of the viability should the card persist. So what happens here, once you have that time period, you also need to decide when, if you've overshot that time period, that card is then deemed irrecoverable, right? So it becomes an impaired debt, right? And so cover as well the circumstances under which card is not repaid. So you provide some guidance in terms of the card. Okay, just a few more slides. So what's the latest in the latest TOF? I mentioned that there was a TOF in 2010 and that's superseded by 2019 one. So this latest TOF talks about multiple tabarruk funds and talks about they defined the participants' investment account into two. One is an investment account and the other one was a savings account. And for its participants' individual account, I think that's the correct term for it. So investment account, the value of your investment would fluctuate, but you can also have a PIF savings account, which provides for capital protection, almost like a bank deposit, right? And it also allows, second point here, it also allows for a tabarruk fund to provide survival benefits. These are the cash payments that you see very popular in endowment policies now. So participants now also share the investment risk, right? So the card for savings participant fund is the contract that underlines this PIF for savings. So it guarantees the participants' investments. Okay. Two more slides. Okay. I think I've mentioned that our regulators really want to regulate on a level playing field. Of course, there's Takaful'S specificities, but they're not playing favorites. They do want to see both industries regulate on a level playing field. But what we've seen as drawback is that here right now in Malaysia, the product designs are too similar, right? From a consumer viewpoint, apart from the Sharia compliance, no clear differentiation between the two products of Takaful and insurance. We still see that. And on commoditized product like mortgage, like motor, sales are still driven by price, right? Consumers, they don't really care about the surplus sharing value. That's not illustrated. I think regulators come down hard that you're not allowed to illustrate that uncertain surplus sharing. So sales are driven by price. And if you've been paying close attention, you will see that even though it's same level of business, for Takaful operators, it's quite stressful to achieve a similar level of return on capital to conventional. So if you're writing the similar kind of business that gives you similar loss ratios, for the Takaful operator, they will expect to get a smaller share because you're sharing the surplus in the risk fund, right? So they're not taking all the surplus profits from the insurance activities. So there's evident stress to achieve good return on capital, even though the capital requirement is similar. So future development, very quickly, because I want to go into the Q&A. Evolution of Takaful industry is, of course, aligned to the regulatory guidelines, very influenced by the regulatory guidelines. We're very fortunate that our government wants, one of its agenda is to make Islamic finance a success. One exciting development is this fintech regulatory sandbox. So that provides for innovative regulatory development. I know some are going through that sandbox right now. But having said, we've covered regulations a lot, but compliance to regulation is not the sole challenge for Takaful to drive. Just to point out that here, the same problem as anywhere else, there's a low awareness of the concept of financial protection amongst Muslims. Right? So elsewhere, we see that this is covered by providing specific regulations to business such as microinsurance. That's not happening here yet in Malaysia. Okay, that's my presentation. I'm looking at Slido and getting quite scared with the list of questions that you have. I'll try and answer that, yeah.
Let's move to Slido.
Yep.
First question, is there a maximum limit in wakalah fee in the regulation, or operators are free to set the wakalah fee?
Yeah, I'm not sure that you wrote this after I covered that bit. So there is no percentage limit, no ringgit limit in terms of the wakalah fee, but there are guidance on what the wakalah fee is supposed to cover. So I've mentioned just now, it needs to reflect services that's rendered. It can only be charged one time for that particular service. It is silent in terms of the profit loading that you incorporate into the wakalah fee. So no maximum limit, right?
Yeah, probably except for the new life framework where we have the math.
Yeah, so that's not quite wakalah fee, but the investment linked framework, the life framework, talks about a minimum allocation rate for investment linked products, right? Yeah, yep. So yes, that's true.
Okay, second question. In your experience, do more TO relies on wakalah fee or surplus as their main profit driver?
If you can have that profit margin up front, then of course you would want that in the wakalah fee. But we do see surplus being built within the profit loading being built into surplus or the risk fund to ensure that the risk fund is sustainable. I would say for life products, and Joanne, you can help me with this. I do still see some profits coming out from the risk fund surplus. That is quite a fair share of profit drivers for family Takaful operators here in Malaysia.
Yeah, I think they're a mixture of both wakalah fee and surplus from the risk fund. Okay, next question. This is interesting. TO and participants fund should be two legal entities in Malaysian regulation, or these are under one legal entity. Which one is the correct way?
You
Okay,
saw my slide on the FSA, right? So it talks about maintaining two separate funds, but I would say that it's one legal entity, right? But it's separate funds. So you can't commingle the assets, you can't commingle the investments. Very clear in terms of what charges are between the funds, but they're not two separate legal entities.
Yep. Next one. Do you foresee more general Takaful players in the futures compared to the current four?
Personally, I don't see it, and if Shuhadas in this call or anyone in general Takaful can add, be more happy for you to add. But I don't see it simply because general insurance is a very competitive. I mean, if you're talking about motor, for example, it's a very competitive market. So you need to be very strong as you come in, and there's that issue of achieving that critical size. But I don't know, perhaps there are some large MNCs looking at having a general Takaful space here in Malaysia. So perhaps there will be.
Okay, next one. If TO set higher wakala fee causing no much surplus left, is the value proposition still making sense?
No. If you have no surplus left, so there is no surplus sharing, right? As I said, that so far we've not seen those cases. We do still see in Malaysia at least margins being built into the taparu, so there is usually a surplus share. They're not incentivized, even though it makes commercial sense, but they're not incentivized to earn all their profit margin upfront within the wakala fee. So to answer your question, of course, if there's no surplus left, there is no value proposition in that surplus sharing proposition. Yes, I would agree.
Okay. Next one, is it appropriate to consider surplus transferred to TO as one of the component in calculating the expense reserve?
Joanne, I think we both do this on a general, and overall, when we talk about expense reserve, we do consider the surplus that is being transferred from the risk fund in our calculation of the expense reserve.
Yeah. This depends on the regulation as well. I think in Bank Negara regulation, I think it's stated that if the actuary think that it's quite high certainty that they can get the surplus sharing from the Tabaru Fund, the PRF, then they can consider it as part of the income while they compute the expense reserve.
Yeah.
So
I admit to incorporating that in some of my expense reserve calculations.
Yeah, if during the pricing, I think if the actuary allowed for quite a bit of margin in the risk fund, I think it's probably appropriate to allow for that to be reflected in the expense reserve.
Yes, because expense reserve is supposed to be realistic, right? So if realistically you're assuming that there will be some contribution from the risk fund, you do take that into account in your cash flow projections.
Yes, agreed. Next one, how is the surplus ratio of general and family Takaful operators?
Yeah. We talk about what's happening in Malaysia. In Malaysia, it's really 50-50. So the maximum amount that you can take would be the amount that you distribute to participants. But having said that, in other jurisdiction, it could be a lot higher to the operator. And as well as the older policies that we saw pre-TOF, pre-2010, the ratios could be, similar to conventional 10-90, 80-20, and generally it was, unfortunately, I think it was geared more towards the operator. right? But now it's been regulated, so the maximum you can take is 50/50 for both general and family takaful.
Okay. Next one, from the experience of Takaful business in Malaysia, what are some of the major risks experienced by the participants and the operators?
What is the major risk experienced by the participant and by the operator? This is a very, you can interpret this in so many ways. I'll give you one example for two products that I see for family. For investment-linked products, your risk is because as a participant, you're now taking the investment risk. So anything that happens to the value of your investments will impact your cover if it's not enough. So we see, for example, during the pandemic, the unit value of your investment-linked plans have dropped quite significantly. And if you have, if you're new, I mean, if you've got a small fund, you might not be sufficient to meet the tabarut that you need to pay. So you're exposed to the policy lapsing because you don't have enough within your unit fund. So that's for investment linked. The other risk for participants, I would say, again, from the family perspective, if you think about medical products, medical takaful, even for conventional, major risk is that you kind of expected the products to be priced more expensive as you get older. But what you don't see in most of the sales illustration is that they've not incorporated medical inflation beyond a certain number of years. So there is an expectation for the price of medical products to be even higher, right? So whether you can afford that. So that's one of the risks for participants. So that would be my answer to that, as an example to those questions.
No. Next one, thanks for the presentation. Tabarut fund should be separate for such as PA risks and life and health risks.
We normally see the long-term risk in one fund and the short-term risk such as PA and medical within another fund.
Yeah.
But it's up to the operator how you want to define it. In Malaysia, you need to seek regulatory approval. But what makes sense for you as the operator and how you want to manage it? Because obviously, if you cut it up too much, given the restrictions in terms of commingling and cross-subsidization, you don't want to be having too many risk funds.
Yeah, agree. Next one, is there any case where Takaful operators fail to ensure the sustainability of the fund and have to request participants to increase contribution?
We see this a lot for medical products. For other plans, not so much, because overall the tabarut is actually a very small portion of the contribution. So it's normally more than enough to meet sustainability of the fund. But we do see contribution being revised upwards for plans that cover medical, but those tend to be quite expensive and they do inflate quite a bit year on year.
Yes.
So not quite failure, yeah, just to not quite failure to ensure sustainability. It's just the way the claims have progressed.
Yeah. Similar question is the next one, not the coming up one. So it's about medical repricing. The one at the yeah. How do we factor in future medical repricing in initial premium or full sustainability? Medical repricing is almost certain.
From a technical viewpoint, you can more than certainly price those future medical repricing in. You can have a claims inflation assumption and apply that for the full term, right?
Yeah,
if
but it
you're
would be too
selling it to
expensive.
exactly, Joanne. So from a technical viewpoint, there is no reason why you can't factor those future medical repricing in, but you'll find that it's too expensive and you can't sell. So what we see for the moment is how the industry does it is to allow for a cycle of repricing. So they would allow for medical inflation for the next few years, with an expectation that they will have to reprice if medical inflation still grows in the next repricing cycle. Yeah, so yes, agree with you. Medical repricing is almost certain. So when I spoke to a practitioner about this, and I was a bit concerned about the way that this was sold, we came to an understanding that for this kind of products, if you're not just paying for medical, for investment-linked medical products, for example, you're just basically pre-funding. So you're putting in more money now to pre-fund for your future medical costs, but there's no certainty that that will be sustainable. That will be enough. You're just allocating some for funding those future expensive medical costs.
Yep. Last question of the day. Separation of Tabarut and TO funds required 2 reserves. This is more conservative, especially when the reserve is flawed. Should they be combined into one only?
I don't quite understand the question.
Yeah, I
Separation of
think the
Tabarut
question
and
is
TO
that there's 2 funds.
Uh-huh.
Shall we just set up 1 reserve instead of 2 reserves? But I think that the issue is that the 2 funds are owned by a different, has a different owner. And
It's different ownership and different responsibility as well. So the Tabarut fund, the risk fund, is covering claims, is covering your Takaful liability, and the TO funds is to manage expenses.
Yes.
So they have different roles, as well as different owners. So you do have to keep those reserves separate. In the way that Takaful is structured in Malaysia anyway.
Yes, agree.
Is that our last question?
Yes, that's the last question.
Okay.
Okay.
Thank you so much. We have, if I have a look at the chat, there's a lot of questions. I mean, there's a lot of activity on the chat slide. I haven't had a chance to look at it. I hope I've answered all the questions that you have for us. We're still contactable. This slide will be shared with you, and you have my contact details there if you want to pursue some of your line of questioning. Thank you so much for listening. I know it's a pretty dry subject, and I hope I've brought in some practical aspects to interpreting these regulations. Thank you so much for joining me. Thanks, Joanne, for being MC, and Sylvia and ASM for organizing. Thank you.
Thank you, everyone.
Thank you. Bye.